and welcome back to Financial Secrets Revealed. We are still enjoying our collaboration with Allan Gray, and today we are welcoming back Simon Mawhinney. Welcome back to the show, Simon.
Thanks for having me, Amanda. Very good of you.
Excellent. No, we did a bit of a deep dive last time we spoke on the balanced fund, and today we're exploring the stable fund. Now, have you at least been having any adventures since I last saw you? Have you been traveling or done anything exciting?
I can't remember when I last saw you, but I think I have. I've been to the US for some investor meetings with things like companies like Alcoa. CSL did a big capital markets day there. And then all of the US builders that I think every single fund manager in Australia has been wanting to meet with.
Oh, well done.
Yeah.
So a productive time away then.
Yes, no personal travel plans.
Oh, shame.
Yeah.
Well, I hope at least at Christmas time you get a break and get to do something a bit more adventurous.
Yes, I think that's happening. Yeah.
That's the plan.
Yeah.
All right. Now we've run down your qualifications and your history in previous episodes with Macquarie and Alliance Bernstein. So if we jump straight into the stable fund with Allan Gray, a lot of people hear the word stable and they might think, oh, it's a bit boring. It's a bit fixed. It's kind of tarting up cash. How would you describe your stable fund?
There's a lot of what you just said that are bang on the money, to be fair. But the stable fund isn't all cash, and in a whole of fund sense, the word stable really does refer to there being a very low risk of significant drawdown. So capital preservation is important for the stable fund, and by its design, the volatility will always be low. But there is a lot of cash in there from time to time, and I don't think I can do any better with cash than anyone else. So yeah, that part is cash, boring, and then there's the added on bit, the up to 50% of equity that the fund can have, and that's the bit that
perfect.
Different.
So we've done the equity ones, which obviously have that higher volatility element in them, and the stables obviously then created for people who are just not quite that ambitious with their money and want that continuity. Was that the intent behind creating the fund? So who is it actually designed to suit?
Yeah, so you're right. So we have three fund offerings, Allan Gray. Stable is the lowest risk and lowest volatility. Then balanced is in the middle, and then the equity fund is 100% equity with the greatest volatility. And so the stable fund has been designed for people who either can't or won't take on the volatility and the drawdown risk of the broader stock market. And so the can't or shouldn't are probably people in that, the later stage of their lives, and they're into retirement. There's the won't, which is just, there are certain professions, and I'm not naming them, but they're typically very risk averse, and they shouldn't be, but they are. And the stable fund addresses some of that low drawdown risk, but also gives you some access to inflation protected returns and tax efficient returns, which cash doesn't. So it's for people who don't want the higher volatility. And a lot of people, I'm told, do use this as a cash alternative. So many people do have cash that is not expected to be used within the next 6 months or 1 year.
So this is people are putting aside for a housing deposit, or they want to take some time off work for whatever reason and they need that money to not go up, down, sideways while they're in that space. This is the kind of reason to look at stable?
Yeah, it is a reason. I mean, it is important to stress, though, at any time, though, the stable fund can have a modest drawdown. So you can just do the maths. Up to 50% equities in the stable fund. Currently, it's 15%. So if the stock market were to fall 20%, um, and the stable fund equity holdings fell in line, it would only fall 3%, because it has a very low weight to equities at the moment. But there are times at the depths of COVID where we took the equity weight up 40%, and so those people and those scenarios that you describe, Amanda, they're good ones. But also, um, there will be other scenarios where people just think, actually, I'm not very good at um, allocating capital in a counter-cyclical way, and I don't put money to work at the bottom of COVID, and I do chase the next greatest craze, and the end outcome is inferior returns. And so this fund actually should be good for people like that, because it is it's a better capital allocator than what I just described. So yeah, there's a few things. I mean, but I do want to. We once had someone walk into our office and say, "I want to invest in the stable fund. I can't handle any negative returns," and we told them to go and speak to Challenger and buy an annuity.
Yep. Not
Because
what your stable fund's about. If you can do 50 up to 50% in equities.
yeah, I mean, I don't know the data, but there are probably 3/4, maybe 2/4 in the history of the stable fund which have returned negative returns. And yeah, 2/4
Always
out
a
of many,
possibility.
but
Yep.
yeah, it's possible.
So we've spoken a lot about Allan Gray's rather contrarian style. How do you apply that to a stable fund? Does it play out a bit differently to when you've got the equities in a balanced fund where you've got a higher allocation to shares?
Yeah, so effectively, it's exactly the same strategy, populate or philosophy, I should say, populating a different strategy. So when it comes to the stable fund, we use that same contrarian philosophy, but we're more patient. I feel we're patient with the equity fund, but we're even more patient with the stable fund, and we expect an even greater margin of safety than we might expect from an equity fund investment. Um, so it's much the same, but there are a few things that we would probably not choose to include. So there are some companies that have relatively binary outcomes, where the risk of loss is significant on the one side of the fence, and the gains quite significant on the other side of the fence. Now, a company like that in isolation is not a good candidate for the stable fund. I would say that from time to time, depending on the riskiness of the fund or the volatility of the fund, um, the, the there will be times where you would, in a cricket analogy, shoot for fours and sixes or swing for fours and sixes, but in the stable fund, it's more like the ones and twos, and the fours and sixes are a small part of it.
Well, great analogy, seeing we've just had the Ashes, so perfect timing for that one.
Moving on.
Yeah, pretty much. So obviously, you've just said that the objective is to deliver a higher return than cash, less volatile than the other two funds. What sort of levers, depending on where you were born, are you pulling to make those investment decisions? I mean,
Yes.
obviously, at the moment you said 15%, sometimes as high as 40. What drives that?
Yeah. Um, what drives the weighting to equities? Okay, yeah. So um, there isn't a specific. You can take a step back and you can look at the broader stock market today, and you can say, well, relative to history, it's expensive. It trades at a punchy multiple of next year's earnings relative to its own history. So relative to it itself, it's expensive, and therefore it probably makes sense to have a low equity weight. And guess what we do? But it's more that would be the top-down approach, and it's actually the bottom-up that is the one that is more relevant for the fund. Though we do from time to time step back and say, does it make sense, our equity positioning? But there are times when just our general research cadence is very high. There's a lot of new companies coming to the investment committee. There's an ability to invest in 150 Australian listed companies without fear of losing money. Um, and times when you can safely only invest in 40 or 50. And I think we're at the 40 or 50 end of the spectrum. And we can see that the number of new ideas coming to the investment committee has reduced over the last 12 months relative to, say, the last 5 years. And that's a very good litmus test for when the weight to equities needs to be lower. But we also look at margin of safety mathematically. As the market goes up, your discount, whatever discount you have to intrinsic value or thought you had, is being eroded. And so that makes sense to reduce exposure to the equity portion of the stable fund. And then one mustn't forget who our clients are and what we're trying to deliver. And it's for these people who, as we mentioned earlier, can't or won't accept drawdown risk. And if I'm honest, from here, and the stable fund's actually done a relatively, if not very good job relative to cash, but if I was to put on two ends of the spectrum, what would happen if the stock market went up 10% and the stable fund did nothing, relative to what would happen if the stock market went down 10% and the stable fund went down 1%. I think clients would be far happier with the former than the latter in this case.
It's sticking true to label then of being boring and stable, doing exactly what it says it's going to do.
Yeah, well, exactly. Yeah. So we're trying to do that. And, this is, a lot of people do use this as a cash proxy, rightly or wrongly. And some of those people work here. So, yeah, we are really trying to minimize the risk of drawdown in the stable fund.
So markets often, we know, favour a bit of hype or momentum. We've had great runs lately. I know Allan Gray values discipline and patience and long-term thinking, which isn't quite as sexy. So there's this calm pragmatism, that sits behind the investment rather than any flashy predictions. Are you able to give us an idea of what you think is going to play out in the coming 12 months? I've had some people going, oh, look, we've been good for so long, we must be due for something, which is based on, their idea at the time. Is there anything you're seeing in the coming 12 months for 2026 that people should be looking out for?
From an over broader equity market perspective, yeah. I know I'm going to be wrong, but okay, I'm going to roll with this. I did mention earlier that I thought the stock market was expensive. There are pockets that make it obscenely so. So if I think about, and I've spoken about this before, perhaps not with you, Amanda, but Commonwealth Bank, Wesfarmers, and Goodman Group.
I think we've discussed the pins in our eyes.
well, it's more, those are three companies and they're 20% of the market. And the collection of those three companies make for a very expensive 20% of the market. There is another 20% of the market somewhere else which trades at a very attractive price, whose earnings are quite depressed, et cetera, et cetera. And so I overall, I don't feel that positively about the stock market. And I think in 12 months' time, we may well look back and say, jeepers, things have not done well. They may not have done too badly, but they've not done well. And I think that's probably that's what I would suggest is likely to happen. But there will be pockets that do very well and pockets that I think do quite poorly. And it'll be these large, almost blue chip companies that everyone has come to rely on are the ones that will do poorly from here.
And that talk has been around for quite a while, that there's a lack of growth in those big companies and that they are inflated. So that sort of does tie in with a lot of other ones I've heard. Back to the stable fund, investors can find it a bit tricky to be sitting there and plodding when markets are going ahead 10, 20% and, we've got that hype and the flashy, stuff going on in markets. Do you think clients need help from advisors to stay disciplined, or do you think people who are attracted to this fund are naturally a more cautious style of investor anyway?
Yeah, I think there's a natural, more cautious investor style to the people attracted to this fund, though we can see that the temptation to chase after uh, other asset classes that are doing much, much better is great for at least some of the investors here. And plus, oftentimes people will use the stable fund as a stopgap, a bit like you said earlier. I've sold my home, let me put something in there until I've bought a new home or whatever it is. Um, and so we do find that it can be a little bit of a halfway house with the final destination being the next greatest craze. But yeah, for the most part, I think people are quite disciplined. Yeah, I mean, we're always, this fund is never going to attract anyone, not for long periods of time anyway, who is flighty and wants to generate 10% plus real returns over time. Not that that's possible, but a lot of people think it is. This is going to shoot for
Well,
those
when you
ones.
figure that out, I'll join you in drinking pina coladas in Bermuda.
Yeah, well, yeah. We may be drinking a lot more than that.
More top shelf, definitely. So there's, I suppose, less emotional challenge to run the stable style of fund where you're like, what are we going to avoid losing rather than how much can we gain? Do you think there's times when investors are more attracted to that? Like, would a big bout of volatility where people, can lose a bit and get emotional send them towards a more stable style?
We have seen that. So our sister company in South Africa has seen that phenomenon where volatility takes people away from the risk classes to something like the stable fund, which we also have in South Africa. But I haven't actually. I mean, the stable fund has been around here for a while, 15 years, if I were to guess, and I haven't really seen that phenomenon happen here. We have had bouts of volatility, but they've been very short-lived. We've had the financial crisis, which was over in an instant. Um, and COVID was a bit the same. The stable fund went into the COVID drawdown with more or less the same level of equity as it has now. But very quickly we were off to the races again, and it's been, everyone's been partying like 1989 ever since. So, yeah, I want to think so, but I don't know. Um, but this will uh, be a reasonable home for people who are searching for that anti-volatility kind of outcome, even in those volatile times.
So, given that you're looking for a much smoother return, what sort of assets, aside from cash, are held in the stable fund, and how do they help with that smoothing of the returns?
Yeah, so the biggest tool, or the one is the one that you said, other than. So, I mean, cash shouldn't be underestimated, but the other smoothing we that introduce is having the equity portion is patiently accumulated. It's very diversified in terms of holdings with uncorrelated returns, and so they typically perform well, not as one, and quite differently to the stock market. And so that really helps with the smoothing of the equity component. And then from time to time, we do use some fixed income securities. But as the fund is currently configured, the opportunity for fixed income securities is very low, the investable universe for us. We probably will get to that, but it's mostly the smoothness is mostly ensuring that the capital allocation is countercyclical, that we're not chasing anything up, and the things that we are buying are at a very significant discount to intrinsic value and quite uncorrelated with one another.
So, how do you think about credit risk then, or duration, when including fixed income assets into the fund rather than equities?
Yeah. Okay. So this is perhaps where there may be a bit of a misunderstanding. So there's no credit risk from fixed income securities in
At all?
the in the stable fund at all. I
Brilliant.
mean, there are times where we wonder whether we should allow ourselves that opportunity, but as it currently stands, that is not an investable security. So the investment universe is, from a fixed income perspective, is the big four banks and Commonwealth government. So you have to be rated at or better. You have to be one of the big four banks, whatever their ratings are at the time, or the Commonwealth government, so risk-free. And then from a duration perspective, yeah, that is something else that the stable fund does not take. And the stable fund's duration limit is 1 year. Again, something we've toyed with changing, but not to the point where we want to introduce a lot of duration into the stable fund. It would be handy to have 2 or 3 years as a permissible level, but no duration, no credit in the stable fund. Not now, almost not ever. There may be some time where, so you can buy a government bond that's 2 years out rather than buying one that's 6 months out. The 2 year out one is more liquid. The spreads are tighter. It makes more sense. It's still not a lot of duration.
Great. Glad we've cleared up that one. So, looking back in the last few years, have there been any moments when the strategy has been tested, and what lessons come out of those moments?
Yeah. So yeah. So the COVID was the big test, and it was for a few reasons, but the biggest one actually was the liquidity of the portfolio. So when I say we hold cash, the vast majority of that cash is invested in term deposits, and today those term deposits have a duration of 3 months or less. And when there were big drawdowns, as they were in COVID, so we have 5% or so that's in cash on call, ready and waiting. And that covers off on a lot of things like if there's a redemption from the stable fund, it can be easily funded. Or if there is a company you really want to add to the stable fund, you can easily fund that. During COVID, the initial response to COVID was, get me out of everything. And so we had both. We had the redemptions, not significant, but significant enough in light of that 5% cash on call amount I mentioned. And then at the same time, there was me wanting to buy more and more equities and needing cash to do that. And so it didn't take long for the full 5% to be gobbled up. And some of the term deposits had maturities that were up to a year at that time. They were all staggered. And so that was a challenge. And luckily during COVID, the banks were quite open to having term deposits cancelled without penalty, but that won't always be the case. And so now one of the big learnings for the stable fund has been to have far more on short duration term deposits, so mostly 3 months, which is where the vast bulk of it is, and then some liquidity in government bonds, a 1 year government bond or so. And so that's mainly been the biggest learning. At times, because of the way the stable fund is, you might want to allocate capital to equities faster than the term deposits will allow you to. But equally, the other side of the same coin is perhaps you shouldn't, because markets do fall for a while and you can just lean in. So yeah, but the liquidity was definitely something during a COVID-style event that we've used to change how we structure the fund. And I don't think we've left returns on the table in that process. We've just made sure that a COVID event wouldn't kill us.
Yeah. I think coming into 2025, there was a lot of talk about there's going to be all these interest rate cuts, and, for mortgage holders, it was going to be all these wonderful things happening again to get back down to those lows that we'd looked at. But we seem to be living in a world of higher inflation now, and all those cuts hadn't happened that they were thinking about. We're also living in a world where geopolitics is playing a much bigger part in people's thinking. Do you think the word stability has changed a bit in the recent few years?
Yeah. Notwithstanding those big events, geopolitical uncertainty or frictions and inflation, things have been quite stable. Equity markets have been incredibly resilient. It's been very surprising. Big wars in the Middle East and Russia, Ukraine dragging on, inflation surprising to the upside, and yet the stock market has powered on. So I think the view of the word stability um, may not have changed, but our attitude and expectation that things are going to glide along quite smoothly has almost cemented itself in investor expectations. And I think that is the issue, that there was an expectation building and has built that the returns will be stable. Um, and I don't think that is the case. And I think we need to condition ourselves to expect a drawdown at some stage.
Brace ourselves. That's the lesson on that one. Well, it always happens, doesn't it? Eventually.
Yeah. But also calm and unemotive capital allocation during those times is very important. I mean, there have been lots of studies on this stuff.
So you're the cool as a cucumber when everyone else is going to pot.
Yeah, I mean, I'm only human. I mean, but we try to be allocating capital in the depths of COVID was hard, but it felt right and it made sense. And we have an amazing knack, humans, to get out of all sorts of pickles eventually. And
Eventually.
yeah, so.
So, for any investors that are listening to the talk today about the stable fund, where do you think it particularly fits well within a portfolio, especially in relation to a retirement strategy then?
Yeah, so I would say it is a bit of a cash proxy. I would expect it to outperform cash, and I would expect those excess returns to be delivered in a tax efficient manner. So fully franked dividends, discounted capital gains, and the like. And so it makes sense to. And the other point I probably would make is the inflation adjusted returns that this fund should deliver. So it does make sense to displace a lot of the cash holdings that exist in retirement portfolios at the moment. This I think is sure, there's a risk that it has a drawdown, but over time it should recover. The capital allocation should shift countercyclically, and the returns will come. So I think it should really displace cash, and a reasonable amount of it. But it's not an equity substitute, and it's not a balanced fund. I think the balanced and the equity fund are, better for those kinds of things. But yeah, I mean, there's a part of me that thinks that this could be the entirety of a retiree's portfolio.
Because you've still got that area of equities, but the investor themselves doesn't have to make those decisions. They're allowing you to do that on their behalf and make those calls.
And exactly, and a significant part of the portfolio is invested in cash,
So
especially at times of
as well.
elevated markets like now.
Do you have any one single guiding principle that you would share with people who are more naturally cautious when it comes to investing?
Yeah, I mean, that's not a bad trait when it comes to investing, and there's far too many people on the other side of the fence. And for right now, I would say stay cautious. If you have been, remain so, and see what happens, and maybe set a diary note for 2 years' time to reflect on that caution. But if you have a reasonably long time horizon and you're still cautious, generally speaking, that is a suboptimal risk setting for someone with a decent time horizon. But I assume many of the cautious people out there have shorter time horizons, and this is not the time to be allocating capital to risky assets, I don't think. So
Hold the course.
Yeah, I would absolutely say that. And then reflect in a couple of years.
Excellent. So we've talked about Allan Gray's broader philosophy. We've talked about the three funds. We've got our stable, balanced, and equity that all seem to be very good at staying in their lanes. Do you think the stable fund says anything else about the firm's DNA and their approach to investing?
Yes, I do actually. We are we are counter-cyclical investors. We think that the greatest returns come from buying good companies at depressed prices, with those prices being the result of some bad news associated with the company. It might be company specific, or it could be a long and deep cyclical drawdown that has made people give up. And that is our underlying DNA. Buy things cheaply, and you can only buy them cheaply when there is some bad news associated with the companies. And this is exactly what the stable fund does as well. Focuses on the counter-cyclical areas where it should allocate capital, and hold these companies for 2 to 3 years and see what happens. So, yeah, there is a lot about what's in the stable fund that embodies our overall DNA, but it's true for the balanced and the equity funds as well. It's just the scale with which we do it in the stable fund is somewhat reduced.
And one last question. I can't believe we're wrapping up already. What gives you confidence, Simon, in stability, even when markets don't seem to favour it at any given moment?
So confidence in the stability of the stable fund's returns themselves, yeah. Well, maths mostly at the moment. So if 85% is cash, that's quite a ballast for a fund at this point in the cycle. But the other 15% that's not cash, we have a reasonably, well, I think very deep and proven track record in managing equities and investing in equities in a way which over reasonably long periods of time has exceeded the stock market's returns. And so I think that we should be able to do that in future. There's nothing that's really changed. The big question is, from now, in absolute terms, is that going to deliver returns? And that's the thing the stable fund is preoccupied with most, because it's an absolute return fund as opposed to the others, which are relative return funds. So, I mean, that is an unknown, but it is one of the reasons why the equity weight in the stable fund is so low at the moment, the lowest it's ever been. And but yeah, I feel from here, because nothing has changed, because the fund is managed in the same way it's always been managed, our underlying philosophy seems to have delivered results. I'm pretty confident the stable fund will deliver a stable return going forwards, I guess, with stability and stable being in the eyes of the beholder, but significantly less volatile than the stock market, more or less in line with the cash rate plus a bit. But there will be short periods where there are deviations, and luckily for us, those short periods have been positive deviations of late, but they won't always be.
And I suppose almost a personal question to finish with. You've got academic qualifications in what you've done. You've got practical experience of a couple of decades. There's obviously been pressure over time, I guess, about being a contrarian style investor. Has your experience now, has that ever made you doubt your convictions, or what you've seen over time, has it more reinforced the way you choose to invest with Allan Gray?
Yeah. Wow, Amanda.
Just throwing you under the bus there on the spot.
Yeah,
so I suppose it could be swings and roundabouts where you're sitting there sometimes going, oh my God, why? Versus we nailed it.
So for us, I mean, contrarian is, we're a deep value manager, and we call ourselves contrarian, value oriented, and long term. But it has been a bad time for investors like us over the last 15 to 20 years. In fact, ever since the financial crisis. And what has really worked over those 15 or 20 years has been growthy stuff and momentum-y stuff. But all of that has changed recently, and you've seen you've seen a value revival, and the growth and momentum managers and capital allocators have really struggled. So there's been a lot of times where it's been possible and easy to sit back and say, actually, this value contrarian style of investing doesn't work, or where it does work. And we have done reasonably well. I don't want to blow my own trumpet relative to the benchmark, but there are reasonably long periods of famine and short periods of feast. But you're more likely from a time perspective to be in a famine period. And so you do reflect a lot, and one does think that from time to time these companies that you're investing in may be broken. But at the end of the day, and the thing that we take some comfort in, if not a lot, is that if a company is not structurally broken, it goes through cycles, and within that ecosystem, the participants need to make a return. And so investing counter-cyclically in companies that are very lowly priced relative to what normal earnings should be has for many, many, many decades paid off, and it is paying off. And those companies will likely continue to go through the same cycles. The challenge is when you accidentally mistake a structurally impaired company for a cyclically impacted one. And that is the big issue. So reflecting on the strategy, it's not that the strategy doesn't work. It's that when you make a real balls up, the 40% of the time that you get it wrong, what is it about that mistake that you have made and don't want to make again? And invariably for us, it's been a structural issue with the company that we mistook for being a cycle. And there have been lots of those examples, but it is the kind of thing that trips up a lot of value managers over their careers. It's the things that everyone refers to as value traps. They exist, and there's just no way to avoid it. Sorry, that's my computer ringing in the background.
Oh, good. Oh, good. No, thank you so much for sharing. It was a big question to throw at you right at the end there, and I thank you for your honesty in answering it, Simon. Really appreciate it. So
no, that's no problem at all.
Good. No, I've enjoyed our time and doing the deep dive on Allan Gray, and thank you so much again for your insights. Appreciate your time.
Okay, Amanda, I hope that's helpful. Thank you for your time.